My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content.
Hey gang, welcome back. If you're Canadian, chances are you've had curiosity about investing in the States. If you're American, you probably haven't had any curiosity about investing in Canada, but you're probably interested in investing in multifamily as well. And today's special guest, now zooming in from Florida, he used to be in beautiful British Columbia, but he has moved his family to south of the border. Got a very experienced real estate entrepreneur, capital raiser, and fellow podcaster, Mr. August Biniaz. Awesome. August, welcome to the show. Great to have you again, my friend.
Dave, absolute pleasure. Long time no see. Glad to be here. Hope to add value to your audience and get to chat with you, my friend.
Yeah, likewise. So awesome. So August, give us a little snapshot of these days, end of 2025. By the time this comes out, it'll be 2026. What are you guys investing in these days?
Yeah, no, here at CPI, we really run an integrated platform focused on two core strategies, multifamily value add, and the business model, therefore, people who might not be familiar with it, is buying somewhat older apartment communities. In the U.S. is very common, these apartment communities. Close to 10% of the population lives in apartment communities in the U.S., but some of them are somewhat older. They're in need of upgrades. So the business plan is to purchase the property, do renovations, exterior, interior, upgrade the tenant profile, make the property run more efficiently, find creative ways to increase the income of the property, and in turn increasing the investor economics because we raise money from investors to buy these properties, and that's the goal, is to achieve the highest return for our investors. So that's one of our strategies is multifamily value add in Texas and Florida. And other strategy is build to rent. Build to rent is a unique asset class under the commercial real estate umbrella. It falls under multifamily, but it's purpose-built rental communities where institutions have actually got very much involved in these properties. So as I describe it, is purpose-built rental communities. You buy a piece of land, entitle that land, rezone it as is known in Canada, build purpose-built rentals if it's a single family, duplex, triplex, and stabilize it. So start renting them out. And the exit strategy differs. So you could either stabilize it and sell to an institution, or stabilize it, refinance and hold it longer. Or in our case we've partnered with a local developer in Texas as our joint venture partner, and we're building these communities. And the plan there is to pre-sell these duplexes to individual investors to buy these for cash flow. It de-risks the project. They're all individually titled, and they buy the duplex, and our developer partner also has a property management arm, so they manage the property. So those are two strategies that we focus on: build to rent development and multifamily value add.
So August, last time we chatted, it was before the you-know-what hit the fan. And I know I've interviewed a lot of multifamily folks over the last year or two who used to be into the whole value add thing, but then the market got crazy, it heated up, everybody and their dog was jumping in. Lots of people who didn't know what they're doing were overpaying for properties. There's just like a buying frenzy in multifamily, almost like what's happened in single family at different times. How has that affected you guys and what you do?
I mean, if you're in the multifamily space and you're buying deals anytime over the last 5 years, there's a chance you're either in distress, you either lost LP equity, or you're in trouble. Luckily for CPI, we haven't been in any serious distress as of yet. There's a couple of deals that we partnered with a couple other groups, because initially when we started the firm, we didn't have the infrastructure to do the acquisitions and asset management. So we partnered with other groups on a co-GP basis. So a couple of those deals are pretty hairy, pretty difficult. One of the deals was sold. We didn't lose any LP equity, but we were only able to achieve the preferred returns that were offered to investors on that deal. So it was hard on the GP as well, right? Because the GP gets a portion of the upside. So if there's no upside, the GP doesn't get paid either. and if there is enough money to pay the preferred return. So, absolutely. It's been a difficult time. I mean, you talk about the cataclysmic event that happened with COVID, where everything shut down for a few months, but the central banks around the world were really concerned. So they started printing a lot of money, but they also started dropping rates. So the U.S. Fed's funds rate came down to 0 to 0.25 and stayed there for a while. So it was literally you were being paid to borrow money. If inflation
became the norm, right? Everybody kind of thought that was normal, especially the new guys getting in.
Exactly. So, a lot of groups started buying a lot of deals, thinking that the gravy train would continue, and they got themselves in trouble. But it's important to note that GFC happened in 2008. The bottom of the market didn't come till 2011. That's when 2010, 2011 liquidation started happening, and the bottom of the market was really in 2011. But from 2011 to 2019, the U.S. real estate market, multifamily and residential, went on a bull run. Completely insane how well it did. So we were already in mania territory before COVID hit. So COVID threw a wrench in everything, but a lot of syndicators or investment firms that had got used to putting bridge debt on deals over that period from 2011 2019, they were starting utilize the same model, not realizing that commercial loans, unlike residential loans in the U.S., are only for 3 years, 3 to 5 years approximately, right? Yeah. 3 plus 1 plus 1. So, your rate is only good for that amount. You might buy a rate cap, which is an insurance policy basically that kicks in if your rate goes over a certain strike point. But they got used to putting bridge debt on deals. But when the Fed started increasing rates 11 consecutive times and a couple more times after that, going from 0 to 0.25 to all the way to 5 to 5.25, it really created a lot of distress in the market. And that also, another aspect of it was compounded with hyper supply. So when debt was cheap, not only syndicators and value-add investors were buying, developers were buying land and building as well. So a lot of markets like the Phoenix, Dallas-Fort Worth, some Florida markets, you started seeing a lot of supply coming online. So when supply comes on, first thing that it affects is rents and occupancy in all the asset classes, in multifamily and single family and built to rent. So you had interest rates that increased astronomically. You had oversupply, hypersupply, a lot of supply in the market. You had rents compressing, and you had vacancy increasing. So that perfect storm resulted in a lot of distress, and it continues. Now we're looking at deals in Tampa in Florida and San Antonio in Texas, and we're seeing a lot of distress coming online. So very interesting time, but that's part of real estate. Real estate is cyclical. It goes through this continuous cycle of recession, recovery, expansion, and hypersupply. And, you try your best to stay afloat and make it through the cycles and survive and continue, making money for your investors and for your partners and employees.
So, August, some of the folks that I've interviewed recently used to be in the value add side of things. They found that a little bit more difficult these days due to the costs of doing renovations and things like that. Some of them mentioned it's cheaper these days to buy a brand new building that's already optimized sometimes than it is to buy a fixer-upper and then actually fix it up and go through all that time, trouble, and expense. What have you guys seen in that area?
Yeah, our issue hasn't really been inflation or cost overrun when it comes to material and labor. The main issue is that deals are just not penciling, and there isn't a lot of deals coming onto the market. And the deals that are coming in the market and we're underwriting, we're trying to achieve 15 to 20% average annualized returns for our investors over, let's say, a 5-year period. That's cash flow, in addition to any upside that exists at sale. So we're trying to achieve 15 to 20%. That's really where the numbers start up, right? What is the LP economics you're trying to achieve? And then you underwrite the deal, see if you can achieve that on the price that the seller is, the broker is giving to you. In our situation, if a broker is telling us this is a $20 million property, we underwrite it and we're coming up to, $18 million, in some cases $16 million. So there's a bid-ask spread there that still exists. That's why the deals are not really penciling for us. And then we follow these deals through our pipeline and through its journey as it comes into our inboxes and goes into our acquisition process. And a lot of deals are not trading, even though they come online. There is a round of best and final, but the deals are just not trading. So we've spoken to a lot of brokers in the markets that we focus in, and they're saying that 70 to 80% of deals that come into the market, they actually don't end up trading.
So what are the sellers doing? They're just sitting on them. They decide not to sell, or they're so they can't afford to sell. Like they're
exactly. So yeah. So in some cases, the sellers are just they're just testing the market, seeing where they're at with deals. Sometimes they're just not. They're shocked about the prices they're getting. They have anchored themselves to the prices that their property was worth in just a few years ago in 2020.
What they paid for it.
What paid for it, exactly. Yeah. That's another big concern. In some cases, they have good debt on it and they don't have to sell, so they're just seeing what they can get. But in some cases, they have to sell. And you've heard this phrase, extend and pretend. A lot of lenders lend out a lot of money in the tune of trillions of dollars in commercial real estate. But a lot of deals started going belly up. And as a result, the lenders start taking those deals back. But the lenders are not operators. So they're not, the properties are high vacancy. It's not being operated well. The Google reviews are terrible. So now they have to sell it below the low note. Even large institutions like Blackstone, there's a couple of deals in San Antonio that came across our desk recently that was owned by Blackstone. They hold a note on it and they were selling it 20% below their note price. And our underwriting came even 10 to 15% below what was their asking, which was already 20% below their note.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
So it's almost like we're going to get into a short sale situation with multifamily properties, it sounds like.
Exactly. Yeah, no, it's, I wouldn't say it's analogous to GFC 2008, but there's a lot of distress because that was more of a total market situation and banking failures. I don't think we're there or we're going to be getting there. This is more about people, in exuberance and mania, paying, buying multifamily 1970s, 1980s deal for a 4 cap. And today they're paying for it because that's really a 6 cap property.
Yeah, I hear you. Now, switching gears to the whole build to rent, that's pretty exciting. How many of those kind of projects have you guys done or are you involved in at the moment?
We're currently building one project in San Antonio, Apollo Oaks, named after my second-born son, actually. It's a 30 duplex project, 60 units, and very interesting asset class. I can give a quick background on build to rent, where this asset class really came from. Sure. But we discussed GFC a few times. But in 2008, when there was such a large calamity and the whole subprime mortgage crisis, real estate prices across the U.S. on single family dropped by 30% nationwide, an average. Yeah. And real estate prices from from around 1948 till till 2008 had gone up every single year, single family home prices, right? So a lot of large institutions like Blackstone, the largest private equity firm in the world that has a larger allocation to real estate that they do to private equity these days, they realized that there was a opportunity here to buy single family homes, but that business model had never been done before. Institution that never got involved in single family, and if they had, it wasn't scattered. They didn't come buy thousands or tens of thousands of homes. Their business plan was very simple. We want to go buy single family homes. We want to buy tens and thousands of them. We don't want to buy the note. We don't want to get involved in debt. We just want to buy the homes itself. We want to manage it, and we want to wait for the cycle to come back, and we want to sell these things. So that's exactly what they did. They actually had the conviction to go ahead and do those. They started Invitation Homes with a partner they had out of UK, and they bought 50,000 single-family homes scattered across the U.S., took that company public, eventually bought 85,000 homes. Blackstone exited that project, and Invitation Homes, still a publicly traded company, did really well. But by 2013, 2014, institutions could no longer buy single-family homes pennies on the dollar. So they actually started building communities of single-family homes, purpose-built rental homes. And the epicenter of this was really, ground zero was in Phoenix. They started building these communities of single-family. So purpose-built rental is served a certain demographic because it wasn't for workforce. It was for renters by choice. It was people who wanted more room, people who wanted a garage. They didn't want somebody living above them, below them. And it really spawned this new asset class, which is known as built-to-rent. Now, SFR, single-family rental, there are firms that just like I mentioned, Invitation Homes, who buys single-family homes, but built-to-rent is its own kind of asset class, and that's the space we're in. We're really bullish on that. We feel there's, especially a new generation, they want to be more mobile. They want to live in Texas for a few years, live in Florida for a few years. So you have a lot of renters by choice. It's a large demographic in the U.S. That rents, and they yield higher rents. The tenants are stickier. There's less, deficiencies and damages done by tenants who live there. So it's a great asset class to be involved in.
So if I recall, what you said was you've partnered with a developer in that area. You guys are building these, and then you're selling them individually to individual investors. And then your developer also has a property management company. Did I remember that correctly?
Perfectly. Exactly.
Yeah.
But keep in mind, we're still syndicating the deal. The equity for the project is still coming from LP investors, like a Canadian, U.S. investors that we have. And that's funding the project. But then, the eventual exit plan is to sell to other types of investors who buy these things for cash flow.
Are you going to hold any of them long term, or are you going to sell them all?
We've been in discussions with our developer partner, and we might come up with a new strategy that is just keeping it long-term, still syndicating the deal, bringing investors, but not exiting them rather than keeping it for a long-term, because we're seeing the investors we're selling to, they're making great returns and they're building equity in these homes over a 5-year period. So we're like, we might just keep it in-house for ourselves.
Yeah, that makes a lot of sense. So as we're wrapping this up, August, one thing that you guys have become really good at is helping Canadians to invest in American deals. Can you give me just a big 30,000-foot overview of how that works? Because a lot of Canadians are worried about investing in the States, and not just because of the political climate and all that kind of stuff that's going on, but the cross-border taxation situation and liability thing is something a lot of people are worried about. What do you tell somebody, a Canadian, when you're showing them how they can invest in the States?
Yeah, my first advice to Canadians who are looking to invest in the U.S. is caveated with is very important who you invest with. If you invest with a U.S. syndicator, a U.S. investment firm, they're just protecting themselves when it comes to the IRS and the securities commissions in the U.S., the SEC. So a lot of times they don't understand the complexity of cross-border, and they don't understand what CRA, Canada Revenue Agency, looks for. So be very careful about who you invest in. But when it comes to CPI Capital, we've really, over the years, we've copied other models of other groups that had paved the road for us, but we realized it wasn't an efficient model. They required their investors to file U.S. taxes and deal with the IRS. The model that we've created is our funds, they file on behalf of our investors. So it alleviates our investors having to file U.S. taxes and what have you. But a 30,000 view on a syndicated deal, which is not a fund model, but a project-specific fund model, is that we find a deal, we locate a deal, be a development deal or a multifamily value-add deal. We create our U.S. entity, which is just a U.S. limited partnership, our U.S. master fund, as we call it. Our U.S. investors invest directly into the U.S. master fund. The U.S. master fund owns the property and gets the loan and so on and so forth. And then we create a Canadian feeder fund. So this is a project-specific fund, project-specific limited partnership, and the Canadian investors invest directly into the Canadian feeder fund, the Canadian limited partnership.
Which is in Canada. That fund is in Canada. Okay.
Hence Canadian limited partnership when I call it that. So Canadian limited partnership. So the investors invest into that Canadian limited partnership. Then the Canadian limited partnership invests into the U.S. limited partnership, just as another investor as the U.S. investors had investors, receiving the same economics, not diluting the Canadian investors. One more layer to understand is in the U.S., when we launch this U.S. limited partnership and we go out there to raise money, we have to oblige by U.S., the SEC and U.S. regulators and so on. And we have to follow their guidelines when it comes to regulatory framework and capital raising and exemptions that exist on the U.S. side. And so when we raise money in the Canadian feeder fund, we have to adhere to Canadian regulations. So it's very important to understand those two. Just something that's allowed or allowed in the U.S. might not be allowed in Canada, and vice versa. So you have to kind of understand both sides of the regulatory framework. Like in Canada, one thing that we do is the limited partnership units that we sell to our investors. We've elected not to sell that directly to our investors and use a third party exempt market dealer who goes out and actually does the sale of securities to our investors. So they're not raising money for us. They're just called a processing EMD. They're actually doing the transaction. So the investor literally sends their money to the exempt market dealer and buys the securities from them. They're the intermediary. And so the exempt market dealer has to do due diligence on us, on our each of principals' backgrounds, making sure that there's nothing that they don't have any issues, background checks, and what have you. And then they also do due diligence on the deal itself to have that deal on their shelf. So there's a lot that goes there. But in the U.S., we sell the securities directly to our investors, so we're not using a third party. There are third party platforms in the U.S. They're known as broker dealers, but their function is not same as it is in Canada, where they're exempt market dealers that are actual processing exempt market. They're not raising money; they're just processing it. So, and then you got taxation. So you got your U.S. accountants who do the accounting on the property level and for investors, giving the K1. So when K1s are issued, there's a K1 issued to that Canadian feeder fund. Just gets one K1. So then our accounting team in Canada takes that K1 and creates sub T5013 for each individual investor. But then the partnership files on taxes on behalf of all the investors, so it alleviates each investor to have to file U.S. taxes. Complicated stuff, but it gets fun.
Well, no, but that's really, really smart. That makes a ton of sense, August. So at this point, you guys have been doing this for a number of years. What percentage of your investors or your capital is Canadian funded versus American funded at this point?
Currently is 70% Canadian, 30% U.S. investors. Yeah. Our U.S. investor numbers were growing at a faster pace than our Canadian investors. We felt it was going to surpass it at some point, but we recently launched a fund in Canada that allows us to raise money from Canadian investors who want to self-direct their registered funds, as they're known in the U.S., retirement accounts, to invest in our syndicated deals. So we recently launched a mutual fund trust, which also allows us to raise those funds. Canadians have close to $2 trillion sitting in their registered funds, retirement accounts, RRSPs, RESPs, TFSAs, and they're literally collecting dust, and they can self-direct them into a syndicated deal, be it a U.S. deal or a Canadian deal, be it a real estate deal or otherwise, without a tax event. So they invest $100,000 in a deal, over a 5-year period to double their money, and that money goes back into their registered account without a tax event, so they don't pay any taxes on it. And people love not paying taxes, right? So, and we feel
a delayed tax event, depending on whether.
Well, a TFSA is 100% tax.
No tax event, exactly.
Yes. August, just very briefly on this last point is that we feel that even though we thought that at some point the U.S. investor numbers will increase and surpass Canadians, with this MFD, we feel that now we've given a push to Canadian numbers. So we might stay at these 70-30 numbers for a bit still.
Well, I think it's a great opportunity for Canadians who want to invest in the States without having to figure it all out on their own. That's for sure. August, if people want to connect with you, where should they go?
I'm very active on LinkedIn, August Biniaz. I'm the only August Biniaz on LinkedIn. I do almost daily posts. So yeah, connect with me on LinkedIn. Send me a message. Say you've seen me on Property Profits with Dave Dubois. I'd love to connect with you. And our podcast, Real Estate Investing Demystified, which you've been on before in the past. And cpicapital.com, our website. Very easy to get a hold of. And hope to connect.
Awesome. August, thanks for being on the show.
Thanks for having me.
All right, everybody. See you on the next one.
Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.